Visiting our Cape Town studios to highlight the most important economic news and data for this week is Peter Worthington. He's from Barclays Africa. Peter, always a pleasure speaking to you. Let's pick up on some of the data that is anticipated to be released, and maybe let's pick up from a central bank perspective. We do have, or rather have seen several central banks across the globe, if I'm not mistaken, more than 20 at least, who have slashed interest rates in response to inflationary, not pressures necessarily, but obviously the relief thereof on the back of the oil price. For the South African MPC, does this set a bit of a precedent for them to follow suit?
I suppose the fall in the oil prices gives them a little bit of breathing room, but I really do not expect them to cut rates. We still have core inflation remaining fairly high, fairly sticky, very much at the upper end of the target range. We have wage settlements, which are a cost push phenomenon, which remain elevated. And of course, we've also seen the oil price bounce back quite sharply. So I don't think the SARB is going to cut, but maybe they might stay on hold a little bit longer than they would have previously.
From cutting to increasing rates, everybody's keeping their eyes out on the US Fed, especially as to what the sentiments that they might share with us on Wednesday. Are you anticipating any surprises, or again, more talks using the word patience with regard to the increase in interest rates there?
Yeah, look, I think our view is more or less the consensus view at the moment, which is after the strong payrolls number that we had, that this is the FOMC meeting where the Fed is actually going to remove the term of needing to remain patient and will instead talk about every decision being fully data dependent. I think it's going to be quite interesting to see how the market reacts to that. There was a very strong reaction to the robust payrolls number that we had a little while ago. So the exact language that the FOMC uses is going to be parsed very carefully by the markets, but the FOMC are pretty good communicators too. I think they'll be quite sound in their language.
Does this mean that for emerging markets like South Africa then that we have a little bit more borrowed time to try to get our ducks in a row?
I think it's going to be very interesting to see how emerging markets like South Africa with large twin deficits respond once the Fed starts to tighten. Some of the countries who were previously considered to be part of the Fragile Five have adjusted materially, seen lower current account deficits, lower fiscal deficits. South Africa still looks somewhat vulnerable on that front. So I think we have a lot of ducks to get in the row. Unfortunately, I don't think that they're problems which can be fixed in time for that first Fed rate hike. They're more of a structural nature that will take quite a number of years to fix.
Unfortunately, clearly South Africa has a lot to get in order. But your anticipations with regard to our quarterly bulletin for the current account balance?
Look, I think we are on the pessimistic end of the range of market forecasts. The consensus was for a deficit of 5.8% of GDP. That's down from 6.3 previously, I believe. But still, it's a very large deficit. We're actually slightly higher. We think we're going to see a deficit of 6.4% of GDP because we actually had a deterioration in the underlying merchandise trade balance during the fourth quarter. So we're at the pessimistic end there. I think that's going to be the release that the market will look at most closely given the pressure that we've seen on the currency recently.
Peter, we did touch on interest rates as well as the drop in the oil price relieving inflationary pressures. From a CPI perspective in South Africa, are we expecting it to remain in that lower level of the target band?
No, I think it's going to bounce back up quite sharply, actually, as due to a combination of tax hikes that were introduced in the budget, due to a combination of a rise in dollar-rand, and also to the bounce that I mentioned previously in crude oil prices. So we are actually, in contrast to our current account forecast, we're on the optimistic side for our inflation forecast. We think we'll see a CPI print of about 3.5%, but that is going to be the low, and thereafter it's going to bounce back up and drift back up into the upper half of the SARB's target range by the end of the year.
Peter, thank you so much for your time today and giving us the important data that we need to look forward to this week. That was Peter Worthington, who's the Senior Economist at Barclays Africa.